believe it or not, but we have already completed over 60% of 2025. Yes, we are already in the month of March. So let's talk about the 4 stocks to buy or put on your watch list. And I'm not going to waste your time in this video. So here are the 4 stocks. And of course, I hope you keep watching. And if not, just leave me a like and a comment. Would really appreciate that. And yes, these are just 4 stocks. There are plenty of other companies that are attractive right now, which is why I've been making more of those videos more recently. Now, I do want to start off with some macro stuff. So on the macro side of things, first of all, the fear and greed index is one of the weirdest thing out there, right? Because sometimes we've been in a bull market for a long time, then we have 2 red days and it's already in the fear side of things. Now we are in extreme fear. Okay, never mind. But then, if we look at trueflation, if for the US, we're at 1.51% and that's dropping. What's also interesting is that if you look at the monthly change in national rent index, the US rents fell 0.2% in January 2025. Of course, we're going to get the February number in the next week or two. What we can see is that we've been constantly falling in the last 6 months or so. Now, it's true that the next 6 months are going to be interesting to watch because the next 6 months are months where in 2024 we have been down as well. So let's see if we're not repeating the same pattern as before, right? So around 6 months being down and then a couple of months up, then down again, then up again, and then now down again. So we'll see what happens, but this definitely, seeing rents down definitely helps the CPI, which should be a good thing when we look at inflation. Now, of course, when we talk about macro, it's all about the probability of something happening, and if it doesn't happen, to adapt to a different situation. So probability is a measure of the belief that a particular event will occur, not a measure of the frequency of that event in the long run. And this is something that I hope the Fed has printed out in big and put into their offices. Now, of course, I know it's always nice to be a perma bull, right? Perma bulls make way more money than perma bears. Like if you've been listening to Tom Lee, for example, I categorize him as a perma bull. Now, remember back in 2021, 2022, well, it wasn't really the best time to buy. Well, late 2022, yes, but you have lost quite a lot of money if you kept buying the highs. And you're probably losing money still today if you bought the highs in 2021. But over a long period of time, being a perma bull is much better than being a perma bear. Now, let's switch to the stocks that we will talk about in this video. Stock number 1 is Nvidia, and we're here on FinChat, the new partner of the channel. So I do appreciate them sponsoring a couple of videos on the channel. Now, right now, Nvidia, believe it or not, but since June of 2024, this stock is actually down 4.6%. Right now, it has a market cap of just over $3 trillion. It actually went under $3 trillion, I think, early Friday. And if we look at the forward PE, that sits at 26.7, price earnings to growth of 0.3. So still quite cheap, all things considered. We also had the recent earnings report, which I thought was an amazing quarter, good comments on the earnings call, yet the stock reacted negatively, which is probably why I'm putting this on the list right now, despite its size. Now, if you watch my videos regularly, you know that I use FinChat pretty much every day. It's been in the videos for a while now. It's a stock research platform that has complete financial data on all stocks globally. And the best part is, of course, that they're the only platform that tracks company-specific data points. Now, more specifically here with Nvidia, you can look at data center revenue. We can then look at gaming, professional visualization, and then automotive revenue, and see how much that has grown in the past couple of years. Of course, this right here is, I keep saying the same thing again and again, this is one of a kind. I mean, look at the growth for data center. I will just put in the last 4 years or so. This thing has grown at a compound annual growth rate of 104%. And of course, that's one of the main reasons why this thing is worth over $3 trillion. And of course, that's one of the main reasons why this company is worth over $3 trillion. Now, as I've told you, FinChat is sponsoring this video, and I'm happy that they're sponsoring the channel right now. All users automatically get 2 weeks for free on FinChat. And if you like the platform and you like to upgrade, you can use my code. You can also click on the link down in the description and the pinned comment to get 15% off FinChat Pro. Now, looking at the average analyst price target for Nvidia right now, it sits 39% higher than the price we're at today. Looking at some valuation metrics, forward PE, forward price to sales, price to free cash flow, EV to EBITDA, believe it or not, it still is under the 5-year average here, with price to free cash flow being the closest one to the average. So yes, despite the stock appreciating so much, as you can see, the business has just grown way quicker. And if we look at what the market is expecting this company to do in the next coming fiscal years, well, free cash flow is expected to grow 62.5% in fiscal 26, another 26.1% in fiscal 27, and then another 18.3% in fiscal 2028 to reach $147.5 billion in free cash flow by 2028, fiscal 2028 that is. This is incredible growth. So yeah, despite all the question marks that we're seeing right now, I think last quarter has shown us that this is a business that is still firing on all cylinders. Now, as you know, I currently do not hold Nvidia in the portfolio, yes, believe it or not, but it's definitely on the watch list. And if there is even more pressure on the stock and for some reason it goes under $100, you never know, then I think it would be too cheap, even cheaper to ignore. Now, talking about too cheap to ignore, I have to talk about, well, my favorite pain pal, which is PayPal. Now, PayPal at the time of making this video has a market cap of $70.2 billion. Yes, the stock over the last 5 years hasn't really done much. It's actually down 37.1%. I did a video yesterday about why I keep buying more shares of PayPal, and I also covered the investor day. So if you're interested in that, that will be in the top right corner. But PayPal, it's still on the list, especially for March, because, well, year to date, shares are down 17.7%. To me, it just doesn't make much sense. If we look at the current average analyst price target, that sits 35% higher than the price we're at right now, despite all the bad sentiment around the stock. If we look at some valuation pricing metrics here, of course, it is much, much lower than the 5-year average, right? Forward PE, price to sales, price to free cash flow, EV to EBITDA, much, much lower than the 5-year average. But of course, we've had, well, that pandemic period where this company was, of course, growing much quicker. And so it got a super high premium. I mean, this was really, now that you're looking at it, this was really crazy times. Like the fact that the forward PE was above 60 for PayPal, and now we're at 14.1 is insane. Now, as I've shown you previously, revenue continues to grow. That's true. But as you've seen, as we've heard management say, revenue is expected to slow down a little bit because they're more focused on profitability. So they're going after profitable growth in the short run. And after that's done, we're going to see revenue reaccelerate. But what's important here is gross profit margin, free cash flow margin. That has seemed to have bottomed out in 2023, because in 2024, free cash flow margin was 21.3%, gross profit margin 40.5%, and I fully expect those to continue to climb a little bit. I don't think we're going to see the tops, right, for gross profit margin. I don't think we're going to go 48, 49% or so. If we can get closer to 45%, that will be great. And then for free cash flow margin, if we can go closer to 25% and also accelerate revenue, I think we'll be in a very, very good spot. And here as well, looking at the expected free cash flow growth for the coming fiscal years, right now analysts are quite bearish because they only see free cash flow growing 1.4% in fiscal 25, then 5.9% in fiscal 26, and then another 7% in fiscal 2027. And remember, the more free cash flow that they can generate, well, essentially the more shares that they will be buying back. And currently with a market cap of $70 billion, well, if they want and let's say they generate more free cash flow than previously expected, and that $7 billion goes towards buying back shares, that's 10% of the shares that they can retire. I mean, you keep doing this on a year-on-year basis, and well, soon enough, you're going to basically take your whole company private. And I know that with PayPal, it's painful to hold it, opportunity cost and all of that, but I really think, and I've explained that in the last video, I really think that with the new management, with the clear vision of one PayPal, I think we can go back to all-time highs. I don't think it's going to happen in a year or two. It's going to take a while, maybe 5 years or so. But if you can 4 to 5x a position in 4 to 5 years, who's going to say no? I'm certainly not saying no, which is why I'm putting PayPal again on this list. Moving on to another fintech player. Yes, of course, it's fintech heavy in this video because I do think that fintech doesn't get that much love, and a lot of these companies are, I would say, fairly priced and sometimes even undervalued, as we've just seen with PayPal. The next one is from Latin America. Nu Holdings has a market cap of $51.8 billion. As you can see, year to date, the stock is now only up 2.5% after being up over 30% at one point. It did come crashing down, as you can see right here, after the earnings report, which we also covered on the channel. I think this was an overreaction, lots of FX headwinds, but then again, this is not the first time that this company is facing FX headwinds. They also talked a little bit about their future, wanting to expand outside of their core markets. And when you have those uncertainties, the market doesn't really like it. But as you will see, this is again not an expensive stock. This is actually a stock that is expected to grow quite rapidly in the coming years. Valuation-wise, really not on the expensive side. And right now, the average analyst price target sits 35% higher than the price we're at today. Looking at only two valuation metrics here because it still is a young-ish company. Forward PE, forward price to sales. I mean, this is not expensive at all. Then a quick recap of what happened last quarter. So they had 114.2 million customers. That's up 20.4 million year over year. 58% of the adult population of Brazil is covered, which is already huge. Of course, that's a huge market for them. So if there are some, currency issues or political issues in Brazil, it does impact a company like Nu. But in my opinion, these things are short-term issues. Out of the 114.2 million customers, there are 94.9 million active customers. That's up 22% year over year. And that's an 83% monthly activity rate. So they managed to grow while also maintaining a quite high monthly activity rate. If we look at what was one of the bearish points that were mentioned in the last couple of quarters, looking at delinquency rates. So if we look at 15 to 90 NPLs, the 90 days that is, you look at the peak here, 5%, and that has come down. Now the problem was that the 90 plus NPLs kept on going up, but management has told us time and time again, look, there are two sides here. There are 15 to 90 days, but what happens after 90 days? They have to go to this group here on the right. Now, this group here on the right will stay there indefinitely, right? Because this is 90 plus days. And so they told us to focus on what has happened a couple of quarters before with the 15 to 90s. And as you can see, that has come down, which is why we're seeing this now with the 90 plus come down as well. They've seen that trend happen and they told us, look, we know what we're doing, but these things will take time to be reflected in the results, which is why we're seeing that we are now at 7% here, and that's down from the 7.2% a quarter ago. Then we've had, of course, their future outlook, which is Act 1, Act 2, Act 3. Right now, they're still mainly in Act 1, which is building the largest and most loved retail banking franchise in Latin America. Then they want to expand beyond financial services and also have a global AI-driven digital banking model. And the questions were about, look, how much focus are you going to put on expanding outside of your core areas? Is that not risky? Should you not continue to grow in your core areas where on a percentage basis, you still have a lot of upside left, what's going on there, etc., etc. And they're saying, look, the majority of our resources are still focused on our core markets. It's just so that we can afford to look and expand elsewhere, which, to be honest, is exactly what you want to hear as an investor. Now, I'm not a holder of Nu anymore, but like I keep saying time and time again, if I will be looking to add a new position, well, it's Nvidia under 100 or probably Nu under $10. Now, for that, I would maybe have to close out another position, because if I want to open a position in Nvidia or Nu, it's definitely not to have a super small position in the portfolio. It's for that position to be quite a big one. So we'll see what happens, but Nu definitely an incredible company, great management that is definitely trading at an attractive price. Moving on to the last one is also a fintech name, one of my favorites, and that's SoFi Technologies. SoFi is trading at a market cap of $15.8 billion. Year on year, the stock is still up 61.8%. So sometimes you have to zoom out and see that this stock has performed quite well. Year to date, only up 2.8%, which is still beating quite a lot of companies right now, believe it or not. So with SoFi, in my opinion, every time it's around $14, $13 or so, I see this as a no-brainer buy. Of course, if you believe in management, if you believe in the SoFi story, then it's a no-brainer. If you don't believe it, then of course, then there is no reason for you to buy. I know some people will look at the forward P and say, 54.5 times for a bank, that's too much. Well, a bank doesn't really grow as fast as SoFi. Plus, SoFi is not a bank, SoFi has a bank. Now, why do I put SoFi on the list despite the average analyst price target being 5% lower than the price we're at right now? Well, pretty simple, because I don't care about what the analysts are thinking. I think the analysts are just wrong on the company. Their estimates are wrong, which is also why you're seeing the pricing metrics higher than what they should be, right? Their expected growth for EPS and all of that for SoFi is much lower than what management expects, right? That EPS in 2026 is supposed to be around 67, 69 cents at the midpoint. Analysts have it just much lower, which is why you're also seeing those future pricing metrics being higher than what they should be. But anyways, I'm looking here at the business. What I'm seeing here is a business that is growing and growing quite fast. It's true that the technology platform should have grown faster, but as Anthony Noto has said in various interviews, this is something that they wish they had way more control over it, but it's just a sector-wide weakness at the moment, a sort of winter period for them. But in 2026, we should start to see things move in the right direction. In the meantime, we have financial services that is growing extremely quickly and lending that is starting to reaccelerate as well, which of course helps the overall revenue profile of the business. And like I said, if we look at the current expectations from analysts, revenue growth of only 20.8% for fiscal 25, then another 19.1% for fiscal 26, and then just 14.4% in fiscal 27. And only in fiscal 2027 are they going to reach 70 cents of earnings, which again does not make any sense. And by the way, don't forget that in the meantime, when the tech platform is weaker than expected, we have another business that a year and a half ago, we didn't really talk about, and that's a growing business, and that's the loan platform business. Low risk, high margins, that's definitely going to drive growth up and up. Plus, again, with SoFi, to me, it's pretty simple. Yes, it's focused in the United States. It's not like Nu that's focused in Latin America. So various countries, plus they want to grow in other countries as well. But SoFi focused in the United States. I know that sentiment, but SoFi doesn't really care about retail investors, etc., etc. Okay, Anthony Noto is not like Vlad from Robinhood or some other CEOs out there. Fine, but what he is a damn good CEO. A CEO's job is to make sure that a company's value goes up over time. A CEO's job is to make sure that the business is performing very, very well. Eventually, the stock will just follow the business performance, right? You do not want a CEO that keeps on talking about the stock on a day-to-day basis. That's not a CEO's job, right? If he actually starts doing that, that's a red flag. But no, he's doing a very, very good job. In the last couple of years, he had to face multiple tailwinds that usually would destroy a business. But guess what happens? Well, so happens that SoFi came out of it as a much stronger company. So yes, SoFi is here again on that list, despite me talking about it for quite a long time and despite me owning quite a big position in that company. I still think that at these prices, it's a no-brainer for the future. Of course, only if you're interested in that business and only if you believe that management can execute on their roadmap. So all in all, that's about it. Of course, on the list of buys, you can see my buying activity in the last couple of days. Alphabet, Micron, AMD, all of them, I've been buying more and more shares. So it's not because I'm talking about those four stocks that the others are not worth buying. I've been buying the other stocks as well. So lots of buying opportunities. You have to think long-term. Short-term, there is going to be volatility for sure. But as I've seen in the last couple of weeks with the earnings report, a lot of these companies are still doing quite well, are still expected to grow, and are still expected to become more and more profitable. in the future. So that's the most important thing here. Calm down, look at the bigger picture. And if you don't like to see red in your portfolio, just don't look at your portfolio during a red day. Pretty simple. Go outside, touch some grass, and live life. Anyways, that's all I've got for you right now. If you enjoy this type of videos, hit all the buttons. Check out the FinChat link down in the description below to get 15% off. And I'll see you all in the next one. Bye-bye.